8 of Dan Zanger's breakout chart patterns is what you're going to be learning about in this video. The video itself is split into 3 main parts. The first part is going to be me teaching you about the 8 breakout chart patterns. I've got charts from 1926 to 2023 to go along with the schematics. We're going to be looking at charts, everything from the 1-minute chart to the weekly chart. The second part of the video is going to be the type of fundamental characteristics that these stocks are ideally displaying as they are building their bases, and then the final part, I'm going to show you a quick and efficient manner to screen for these type of chart patterns. Before we get into it, let you know that MarketSmith are today's video sponsor. There's a discounted trial available in the comments section below. You'll see a couple of the charts as we go throughout the presentation. And with all of that being said, let's do a little bit of an overview. So what are the 8 breakout chart patterns? It's flags and pennants, a cup with handles, flat bases, also known as a Davis box, ascending triangle, symmetrical triangle, wedge formation, inverted head and shoulders, and a parabolic curve. So we're going to be going through examples of each. Now before we get on into it, you'll see moving averages on the charts. The 3 most important moving averages for continuation patterns on the daily chart in my view is the 10-day EMA, the 21-day EMA, and also the 50-day simple moving average. So be paying attention to those lines and the repeatable nature of where are you seeing these sellouts, where are you seeing the stocks finding supporting action on the charts as we go. So let's start off with number 1, flags and pennants. So I've got guidelines and then also some key findings by Boswelski in his book. It's a good book as well if you want to have more of the data behind some of these chart patterns. So Boswelski found it was the number 1 chart pattern, the higher tight flag, number 1 out of 23 in both bull markets and also bear markets. So what are the guidelines for high tight flags, flags and pennants? Both are continuation patterns which usually occur after a big quick move. Flags make a series of lower highs and lower lows with parallel trend lines. You can see that there, lower highs and lower lows coming through. Pennants make a series of lower highs and higher lows. So that's the difference between a flag and a pennant. You can see here that it's making a series of lower highs, but it's also making a series of higher lows as the base is building. Pennants are like symmetrical triangles but smaller in duration. O'Neill high tight flag rule is greater than a 100% move in under 2 months than a base of 3 to 5 weeks, correcting no more than 20 to 25%. Let's get into a couple of examples. So we'll be doing these in chronological order, so we'll be starting from the ones that are furthest back. Now for each of the chart patterns that I'm going to show you, I've got various examples throughout history just to indicate it's basically timeless, right? How these stocks are basing, how they form, the respect for certain moving averages the stocks display, what happens in the base, what happens before the base, what happens with the relative strength line. It's really just supply and demand, training the pattern recognition, because leading stocks tend to act the same. It doesn't matter if it was in 1926 or 2023, they act the same. It also doesn't matter whether it's the 1-minute chart, the weekly chart, the daily chart, as you're going to see as we go. So let me just give you a couple of key pointers as we go throughout this one, right? Now, I've only just want to make a couple of points per slide instead of making a million points per slide. I think that's going to be a little bit better to try and teach it. So clearly you can see the stock is in a strong uptrend, right? It's above all the key moving averages. The strongest stocks will find supportive action on their 10-day EMA, which is the black line. You see this black line here? See how it shake out to Martel here, a little shake out to Martel here, a little bar in here as well, tight little inside bar. I'll come on to those in a second, but you can see the respect the stock shows for the key moving averages and the flag type pattern that forms. You would actually say it's a pennant type pattern, but I'm just going to refer to them as both the same and just call them flags. It's a pennant. Why? Because it's actually building higher highs along with the lower highs building within the base. Now you can clearly see this is a good thing to look for before the stock even starts basing, and this is going to be for the vast majority of stocks that we look at. Do you see the respect that the stock has for the moving average? It's not chopping about all over the place on the way up. No, it's just a really clean, smooth trend staying above the moving averages, and I call this bullish synchronicity. It's where you have widespread candlesticks and the volume is confirming the positive price action. See how volume on a relative basis is around 2, 3, 4 times the 30 bar average, which is this black line here, and see how the bars, they're opening near the low, close near the high, open near the low, close near the high. It's really good to see, and then the stock goes and builds its fag. A little shake out to Martel, low relative volume, so really good sign. I'll come on to more of those a little bit later. And then what I'm looking for with the vast majority of these bases that I'm going to show you in these various chart patterns is these tight little bars. I call them trigger bars because for me, it's the final piece of the proverbial jigsaw puzzle, and where I then want to be targeting the stock, invariably targeting it through the higher the bar, stop loss underneath the lower the bar, or in that vicinity. I've covered that a lot in recent videos on the channel that you can go and look for. Just want to keep it more so focused on the chart patterns themselves. This is a free tool on TradingView down here. Search my name, Jack Corsellis, relative strength line or RS line, and you'll find it. I like to look for stocks that are hitting 52-week highs or have a very strong relative strength line. Why? Because leaders invariably are hitting 52-week highs on the relative strength line before the base, in the base, after the base, as well, as you're going to see. Also keep a note of how do these stocks move after the base as well, because that then feeds into the trade management aspect. For me, I think there's 4 parts of every single trade. I think there's number 1, you've got to identify it. Number 2, control the risk. Number 3, mitigate the risk. And number 4, optimize the profits. So yes, be looking at what happens before the base, in the base, on the breakout, but also keep in your head as well what happens afterwards. What would be some good sell rules to try and keep you in the trend? And then also be thinking about, well, if the stock does get extended, what's an optimal way to be thinking around that? For me, you've probably heard me talk about in recent videos, lower the bar, 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 and just choking it off that way with all a part of the position. It depends. So you can see another flag that forms in here. Now, something to look for on the flags is before the flag even starts forming, sometimes there can be something that happens. Potentially it could be a fantastic reaction to the earnings, or it could be a FDA approval for a brand new revolutionary drug or something like that, right? But if you see this type of action, a massive increase in the share price, huge relative volume coming through, 52-week high coming through, and then the stock starts basing out there afterwards, that's a really constructive sign. Now, something that I like to look for in the base is, do you see how there's these multiple tight candlesticks? Visually, you can see them, right? Multiple tight candlesticks many times during the base, and look how the volume is low on a relative basis as well. So what I've got ingrained in my head is, yes, it's good to look for these chart patterns, but also to have an understanding of the supply and demand dynamics at work as well. So when I see these multiple tight candlesticks and I see low relative volume, to me, I interpret that as it's absorption of supply, and there's limited supply coming to the market. There's not much selling around. That's really constructive behavior to see as these stocks are building these bases. And then you get what I call trigger bars, these really tight bars coming through, which is where the risk versus reward really makes sense in my view. IMGN, so this one here is a biotech stock, so I wouldn't be surprised if this was actually FDA approval back here in 2013. And it's not just that you see, oh, it's a widespread candlestick and there's huge volume coming through. It's what did the candlestick do? And it's really trying to understand the psychology and linking the chart back to supply and demand, buying and selling. What are you seeing? So when I see a big gap up bar like this, it gaps up. So the prior close is here, it gaps up, it opens here. But where's the open of that bar? The open of the bar is the low of the bar, and then it pushes up immediately, and it's obviously a widespread candlestick and there's huge volume coming through. What does this tell me? There is huge demand for this stock. Visually I can see it, but there was an immediate presence of demand as well. Why? Because the stock gapped and the opening price was the low of the day, and then it pushed up higher. That's a really positive thing to see. You can see it also on the breakout candlestick itself coming through in here, and then see how as the stock pulls down to the 21-day EMA, see the respect that it has in here, bounces perfectly off of it. What do you notice about the volume on those 2 bars as well? There's not much volume coming through. What does that tell you? There's not much supply, there's not much selling there, and then you get this really nice, it's almost an inside bar, but it's a really nice trigger bar at the end of this formation. So for me, the trigger bar concept they're looking for is usually a relatively tight inside looking bar. It doesn't have to be an inside bar, but it's a tight bar relative to what I've seen previously in the base, and ideally it's setting up and sitting on the 10-day EMA or the 21-day EMA, potentially the 50 if it's a bigger base. And look at the 52-week highs as well. ACB, this is a cannabis stock in 2017 when the market had a bit of a love affair with them. So see, there's this sudden just rally that comes out of this stock. It's kind of in the doldrums, and then suddenly it just wakes up, right? Darvis spoke about this in his book, that suddenly the plain Jane is suddenly dancing on the tables, like the character of that person, the character of the stock, something has completely changed it. You can visually see it with the price action, with the volume coming through, with the 52-week highs on the relative strength line. This bar here, this is what I call a gap down reversal bar. So again, it's trying to understand, yes, there's these repeatable chart patterns, but what's going on from a supply and demand perspective as well, trying to be like a detective with it. So as we were talking about with IMGN, there was that gap up bar and it opened on the low of the bar and pushed up. If I go back a slide, see this bar here, it's a widespread bar, opens on the low of the bar and pushes up. So there's an immediate presence of demand. Now volume will tell you how much demand is there. There was a lot of demand coming through, right? Visually you can see it in the volume, the spread, the strength of the close. So when we look at ACB here, this is a gap down reversal bar. So the prior close is here. the share price gaps down, so it gaps down, and then the opening price is the low of the bar, and then it pushes up, and volume is maybe 1.25 times, 1.25 times the 30 bar average, and it pushes up and closes on the high of the bar. What does that tell you about the presence of demand on this bar? It tells me there's a lot of demand for this stock, and it was instant. This is also a very good bar for shaking out the weak hands, because in the opening minute it would have looked terrible. It's gapping down in the pre-market. It doesn't look good, right? But it gaps down, open is the low, then push up. There's an immediate presence of demand. Price then comes down, retests that level, which is a confluence of the 21-day EMA. Nice little shakeout demand tail, pops up, and then you start to get the tightness. So this is, again, it's like the Minervini point, the volatility contraction. So volatility contracts and low relative volume coming through tells you what about supply, tells you what about selling. There ain't much supply, there ain't much selling. So then you get this trigger bar. You see this tight little bar here. This for me is when the risk versus reward is extremely favorable. And then you see how the stock here, obviously it's extended here. The stock runs from about $65 over a double to $140. But again, think about this from a trade management aspect. When you're looking at these stocks, lower the bar, lower the bar, lower the bar, lower the bar to choke off some or all a part of the position from a trade management aspect. I really like it doing that when the stock gets extended. You can see how well it would have worked here as well. I think it's really effective that extended stocks can become more extended. So be looking pre-base, in the base, just at the breakout, in the pivot, after as well. What's optimal ways to be managing these shares too. PRTS, this is pretty much as textbook as a textbook high tight flag can basically be. So see how the stock here, it makes a huge move from about $2 up to a high there of around just under $12 or so. And you see how the stock holds its 10-day EMA the whole time, and then it bounces off the 10 in here with this shakeout demand tail. So price goes down and then it bounces off, buyers step back in around the 10-day EMA. Here again, price comes down, shakeout demand tail, bounces off. This is a little gap down reversal bar, nice. And then the 21 starts catching up, bounce off the 21 just about, and then do you see how it's these multiple tight candlesticks and the volume dries up? Don't these last four candlesticks look extremely similar to these last four candlesticks of ACB and IMGN? Look at the tightness in price that comes through with AN as well. Look at the tightness in price that comes through. This is kind of the volatility contraction point, but what does it really mean from a supply and demand perspective? Tightness in price, optimal chart pattern forming, low relative volume, price in relation to key moving averages, leader, 52-week highs on the relative strength line. These are the things to really be dialing in and training to. This one here is WEAV from 2023. So remember what I was talking about earlier. Sometimes it could be the earnings is a spark for the rally that precedes the base. It could be an FDA approval. It could be a new contract award or something like that, right? But here it's the earnings reaction. Really good volume coming through, maybe about 4 or 5 times the 30 bar average. And look at the bullish synchronicity point. There's a synchronicity between what price is doing and what the volume is doing as well. Gap up, open near the low, little shakeout demand tail, strong close, and then rally, bounce off the 10 EMA, and then it starts building this flag. Nice little gap down reverse bar with shakeout demand tail, then tight. Takes a day to go this one, and then again be thinking about the sell rules that come through as well. And then if a stock is hitting 52-week highs in the base, it's very, very strong stock. So a couple of handles. Obviously, William O'Neill spoke about this a lot in his book. So preferred minimum base duration for cup of handles is between 7 and 12 weeks. Guidelines, cup of handles usually form during a market correction and after the stock has rallied above 30%. Better cup of handles will decline 20 to 35% from peak to trough. The less a stock declines, the better indication of its strength. Stocks that decline more than 2 times the general indexes could be showing significant weakness and aren't real true market leaders, TMLs. The handle usually forms within 5 to 10% of the cup high. So this would be the cup high and this would be the handle forming over here. For better selections, nearer the cup high, generally the better, and the handle shouldn't decline more than 10 to 15%. It's quite common that the handle will take a visual shape of, say, a Davis box or something like that, or a little flag in and of its own right, or a VCP or something like that. It's not uncommon to see a shakeout bar, gap down reversal bar, shakeout demand tail within the handle of a cup and handle as well. The handle duration is at least 1 to 2 weeks and forms above the 200-day simple moving average. Boswolski found that it was 13 out of 23 in bull markets and 9 out of 24, or 9 out of 19 in bear markets. So it's an okay chart pattern. So this one here, CTS, this is 1975. I'm going to show you some different variations of these. So you can get cup and handles, and this one here you have to to apply your imagination a little bit to it, but you can get cup and handles that aren't necessarily during a market correction. So this one here, it doesn't look like, say, a Microsoft on the weekly chart in the 1990s, where you get this deeper cup here and then this handle, or say a MicroStrategy, good example of here's the cup and here's the handle. You can get them smaller cup and handles within the context of powerful uptrends that a stock goes through as well. So here's the cup and then here's the handle. Some things that I like to look for is bullish synchronicity before, so widespread candlesticks, volume confirming the move, 52-week highs, and then it's the same point here. Even CTS back in 1975, you see the multiple tight candlesticks and the low relative volume. Just tells me there ain't much supply coming to the market. And then within the handle that forms over here, see how you get a shakeout off the 21-day EMA, and then you get this tight little inside bar, and there's a 52-week high coming from the relative strength line with very low volume on that bar. So it's telling me, number one, there's very little supply coming, there's very little sellers around on this bar here. And where is it happening in the context? Well, it's happening in the context of a cup and a handle. And then do you see how you get 52-week highs while the stock is still within the base? If a stock is hitting 52-week highs while it's still within the base, that for me is an extreme sign of relative strength. The market is under a lot of pressure, so the market is keeping this ball, this basketball if you like, underneath water. When the pressure of the market lifts, this is my expectation, the stock should then pop up there and continue its advance higher. Microsoft weekly chart. So here you can see big shakeout demand tail at the lows of the cup. So large operators, two things they require above everything else: liquidity and perceived value. So I really like to apply a Bayesian mentality. So I update my decision making process as new information becomes available. So if I'm looking at a handle that's forming, I then look back to the cup, and if I see, okay, the lows of the cup had big shakeout demand tails, say on the weekly chart or the daily chart, there were gap down reversal bars. That to me is a really constructive sign to see. And then it's the same point here, tightness in the handle. There's a little cup with handle here. There's a cup and handle within the cup and handle, tightness, low volume. Look at the 52-week highs coming through as the stock's building the handle afterwards as well. Again, the market will not miss the best opportunity. So relative strength, it's not my opinion, it's not your opinion, it's the opinion of the market. I like trading the stocks that display the greatest relative strength. This is Bay Systems UK stock. Look at the bullish synchronicity coming through before the cup and handle forms. So it pulls back down, finds supportive action on its 50-day moving average, tightness in price, generally low relative volume, just says hardly any supply coming to the market. And then see how it builds this handle. This is really constructive. See how the volume stair steps down like this, and then you get 3 bars just tight sideways, mini Davis box in and of its own right. Volume below the 30-bar average. It's just screaming there's hardly any supply that's coming to the market. So you see the tightness in price you invariably get before the stock breaks out of these bases. MicroStrategy. This is back in 1999 when it wasn't involved in Bitcoin. So see how you get this cup and then the handle. And the handle quite commonly will look like a Davis box, basically a rectangle of sorts. It may have kind of a flaggish pennant type look to it as well, but a Davis box in the handle is not uncommon. And I like to then see it setting up at least around its 10-day EMA to indicate it's not extended, but potentially the 21s there, maybe the 50s there if it's a bigger base as well. Now MicroStrategy is not hitting 52-week highs, but can you see how this relative strength line starts turning up as this cup has bottomed? That's a really constructive sign to the RS line improving into where the pivot forms and where the breakout takes place. Netflix 2020. So see how you get this big shakeout demand tail coming down through here. Look at the 52-week highs coming through. Then this is a cup and handle. Then you get this nice shakeout demand tail, low relative volume. Then at it goes. So it's not necessarily the highs of the handle. It's not always the pivot for me. It's actually looking for gap down reverse bars, shakeout demand tails, trigger bars where the risk makes sense. And I've covered that in recent videos. BRCC on the daily chart, really nice example of what you'd like to see at the bottom of a cup. So see, this is the cup, this is the handle. Great example actually of the cup and the handle. So see, its price comes down here, starts finding sportive action around the 21-day EMA being the blue line. Shakeout demand tail, volume around about the 30-bar average, and then just tightness in between. So shakeout demand tails, shakeout weak hands, get them gone. It's a really constructive sign, I think, when you see shakeout demand tails around the lows of a base. It's just a sign that someone is in there accumulating shares. Certainly if it then tightens up, and then do you see how you go tight, and look how the volume just dries up before the stock makes the move out of the base. Next one, flat base, Davis box, or a channel formation. So minimum base duration you'd like to see is ideally 3 to 4 weeks. It's a, as the name basically implies, it's a box, a horizontal consolidation, preferably in a powerful uptrend. Tightness and price and volume drying up is preferable before the breakout, like on all patterns. Boswelski found in terms of the performance rank in a bull market, 12 out of 23, and in a bear market, 19 out of 19. So not very good in a bear market. Tall or wide patterns perform better than short or narrow ones. Interesting. Patterns with a falling volume trend do well. So RES, this is like as textbook of a Davis box. Flat base could basically be. So see how you get bullish synchronicity beforehand. There is a synchronicity between the widespread candlesticks and the volume coming through. Great. And then what moving average does the stock respect? 10-day EMA. And then notice the multiple tight candlesticks and the low relative volume. What's that telling you? There is hardly any supply coming to the market. And remember, I was blabbering on earlier about when the stock starts getting extended. So imagine if you were trading this in 1997 and you were on this day here and you bought it perfectly here and you're like, the stock's stupidly extended, I'm just gonna sell my position. Is that optimal to do over a large series of trades? Probably not, right? So what I like to do is just move my stop loss to the low of the bar and just see how effective it is on these leading stocks. Now this here did a recent Jesse Livermore video about danger signals. This is a clear danger signal. Take a look at the bar here. This is bearish synchronicity. Price opens on the high of the bar, goes out on the low of the bar. Look at the volume. It's the largest volume you've seen thus far. And now this will be split adjusted, but the stock's just run from basically $1 to over $1.60, $1.70. Like, what do you think institutions are doing here? Are they accumulating or are they distributing? What are you visually seeing on the chart? This is a massive danger signal coming through. Show you a couple of others. Oh, also 52-week high in the base, extreme sign of strength. GAIA. So you can get these Davis boxes and all of these chart patterns form from the IPO. So this is the IPO day for this stock in 1999. OK day, there's a big supply sheet, which is where price goes up and comes back down. But from an IPO day, the stock doesn't just tank, it doesn't sell off immediately. It's actually quite constructive. So it opens near the low, pushes up there, and then you get this Davis box form. Generally speaking, tightness in price coming through. The volume dries up as well. Now there's some 52-week lows, but that's because price is like hardly moving. But soon after the breakout, you get the 52-week highs coming through in there, which is quite nice. But see the tightness in price that comes through, and then see how the stock respects its 10-day EMA. Nice trend there afterwards. So be paying attention to how do these stocks move afterwards. Coca-Cola, this one here is on the weekly chart. So again, we can look at things on the 1 minute chart, we could look at things on the daily chart, the weekly chart, the monthly chart. It's just the same thing. It is supply and demand. So on the weekly chart, I've got the 10-week simple moving average being the black line and the 40-week SMA being the red line in there. So 2015 weekly chart. See how you basically get this Davis box. It's a rectangle. Now, what happens in the week before the breakout comes? What do you notice? Tight inside week sitting perfectly on the 10-week moving average, simple moving average, which is very closely aligned with the 50-day moving average on the daily chart. So tight inside bar, low relative volume compared to the 30-bar average tells you what about selling, about supply. There's hardly any coming. Like this here, I think is really important to train your pattern recognition to. Par, another Davis box that forms in here, shakeout demand tail onto the 10, shakeout demand tail onto the 21, and now it's not uncommon to see as well, stocks base, could be a Davis box, a flag, cup and handle, whatever it be, and then the actual breakout from that consolidation is on the earnings or an announcement. In this case here, it's the earnings reaction. Now if you take a look at the earnings bar, this is bullish synchronicity, it's positive. Why? Price gaps up marginally, opens on the low of the bar, pushes up, and look at volume about 2.5 times the 30-bar average, confirming the positive price action. And then note the trend there afterwards as well. Ascending triangle, which you could say is kind of like a volatility contraction pattern as well. Variation of the symmetrical triangle where the top of the triangle appears flat and the bottom is slanting upward, which is making higher lows. Preferable if a pattern appears in a powerful uptrend, like basically all of these continuation type patterns. But as well as you found, it is ranked 17 out of 23 in bull markets and 11 out of 19 in bear markets. Let me do this one here. So we're going to go back to 1926, 1927 with the Dow Jones. Now I appreciate there's a little bit here in this ascending triangle where price actually gets above the high, but if you were to look where the pivot happens, I really want to spend a little bit of time over here of looking for tightness in price. Doesn't matter if it's the weekly chart in the 1920s or 2023, it's the same thing to me. It's supply and demand, okay? And I'm also going to talk about gap down reversal bars and shakeout demand tails because you can see them 97 years ago. It's just supply and demand. It is games the large operators play. So we're on the weekly chart. We've got the 10-week and the 40-week moving. So you could look at this, if you're looking at this as, say, a VCP, a volatility contraction band, you'd go, well, there's one contraction there, there's two there, there's three there, then there's four here. So over here, on this fourth contraction in price, this fourth high low, where price really starts tightening up. And if you look at these final two weekly bars, little shakeout demand tail is then the final bar. Think about the trigger bar concept. It's nearly an inside week, and it's a little shakeout demand tail as well. This is where supply dries up. This is where supply selling stops coming to the market. If we had volume on here, we'd like to see the volume really low. So if we then just draw a horizontal line going back across, you can see that we encapsulate probably 98% of the trading is below this line in here. Sure, there's a couple of weeks, 5 weeks or so, where price is above there, but it's not there for a long time. So I would still look at this as an ascending triangle in my head. So 1 contraction, 2, 3, 4. On the lows of the contractions, what do you notice? This here is a gap down reversal bar. Even in March or April, that's going to be a 1926. What does price do? There's a waterfall in price coming through here. Then this week here, price gaps down from here, 142. Which sounds very low for the Dow Jones, doesn't it, if you think about it now. Down to here to about 135, 34. So it gaps down, opens near the low of the week, pushes up. Gap down, reversal bar. A couple of weeks later, here it happens again. Prior closes here, gaps down, reverses. Low here, shakeout demand tail. Low here, shakeout demand tail. Low here, shakeout demand tail. Over here, gap down, reversal bar. It gaps down, opens here, pushes up here. Gaps down, opens up, pushes here. Shakeout demand tail, holding the 10-week. Nothing's changed. Nothing has changed. Now we go and look on the 1 minute chart in August of 2023. Bullish synchronicity, shakeout demand tail, shakeout demand tail, shakeout demand tail, ascending triangle, 1 contraction, 2 contraction, 3 contraction. 1 minute chart, weekly chart, supply and demand. OLN 1976. So again, it's not always necessarily just drawing a horizontal line across the high of the base. It's understanding supply and demand. Where does the pivot form? Where does the kind of pivotal point, as Livermore called it, and that line of least resistance, where does it really start to form and the pivotal point form? That's where price should move really quickly. For me, it's looking for the tightness in price and the low relative volume. So here you can see shakeout demand tail, little shakeout demand tail, tightness in price, low volume. Look at the 52-week highs, and then note how the leading stocks trend there afterwards. See how well it respects its 10-day. Bounce off here, and then you start to get the change of character. See how the stock is then acting differently visually. Look at it. Look at the candlesticks. Look at the volume. Look at the deterioration in the relative strength as well. Danger signs, as Livermore said. SLM. So some nice bullish synchronicity coming through in the middle of this base. Shakeout demand tail, shakeout demand tail, shakeout demand tail underneath the 21. Then here you get this pretty much tight inside bar. Look at the volume dry up. The bar before that, 52-week high. The stock's hitting 52-week highs in the base in 1986. Nice. This one here, SLG 2006, so ascending triangle. And again, it's not necessarily, you see here, this is hopefully going to illustrate the point in terms of looking for the pivotal point and where it forms. So you see here, price, yes, it breaks out above these highs. It does it here, it does it here. But you see how it runs up like this. It just runs up like that. It doesn't consolidate in a tight manner underneath the pivot, underneath the highs of the base. It's not till price gets over here and you get that period of consolidation. You get that mini Davis box. Look how the volume dries up. The stock's hitting 52-week highs in the base here, in the pivot, as it's forming the pivot. It's hitting 52-week highs here. See the gap down reverse bar here. See the shakeout demand tail here. Another shakeout demand tail here. But it's over here. This is where it really tightens up. It's not running up like that and extended into the breakout. It's these nice contractions in price underneath. That's what I'm really looking for. MVMI. See how price really tightens up in here. Look how the volume dries up, and then this is what you want to see on the breakout bar. Huge relative volume coming through, positive price appreciation, and the stop puts you under no pressure. It just immediately gets out after the entry. Symmetrical triangle. Now these are relatively rare to see like a perfect symmetrical triangle. I'd say this is probably the rarest pattern that I'm going to show you for it to be like this perfect. Chart pattern characterized by lower highs and higher lows, like a pennant, albeit with a symmetrical triangle, the base duration is often longer. Ideally, there is a minimum of 3 upper and 3 lower touch points to form the pattern boundaries. Corsellis found it was ranked 16 out of 23 in bull markets and 7 out of 19 in bear markets. So this is Melly here, and again, it's pretty difficult to find kind of perfect symmetrical triangles. I would say it's the rarest pattern that I'm going to show you in this video. I would say flags and pennants are much more common. Ascending triangles are much more common than a perfect symmetrical triangle. But Melly here, great reaction to the earnings, and then gap down reverse bar, shake out demand tail, and then tightness and price comes through. Look how the volume dries up. Look at the 52-week highs. Out it goes. Nice. And then up here, see how you get this supply shoot up here on large relative volume. So again, if you think it's extended there, price is trying to go up, and supplies bring it back down. Lower the bar, lower the bar. Don't have to necessarily wait for 10 and 21 days or 50-day moving averages to be taken out. HBAN. 2010, good reaction to the earnings coming through, bullish synchronicity, shakeout demand tail just underneath the 21-day EMA. Look at the volume. This is kind of a perfect volume profile that the volume just dries up. You could just draw an arrow here, see how the volume just dries up from left to right in the base, and then see how you get the tightness. 10 and 21 EMA, the usual suspects, not too far away, low relative volume, and then the breakout coming through. Nice. Wedge formations. So wedges characterized by slanted converging trend lines into an apex, volume decreasing as pattern forms and expands on the breakout is preferred. Ideally, there is a minimum of 3 upper and lower touch points to form the patterns. So key Persolwski findings for a falling wedge. Not overly great. Rank bull market 20 out of 23 in bear market, but better 11 out of 19. There's also, Persolwski had broadening descending wedges, 12 out of 23 and 14 out of 19. So let me show you this one. This is Novavax. So there was during the kind of pandemic as well, a lot of the vaccine related stocks, mask stocks as well, went on absolute tear. So it's also thinking about, is there a story, is there a theme here? Are you seeing a lot of relative strength in the brother and sister stocks instead of just a random strong stock in isolation? It's really good if the group is strong as well, or the theme is strong and the brother sister stocks are strong. So Novavax, great reaction to the earnings coming through soon after. In here, pushes up, and then do you see how his price pulls down? Shake out demand tail, shake out demand tail, shake out demand tail, and then just note how the volume dries up. So prices then tightening around the 1021 EMA, basically in here, just building a little Darvis box within the context of this falling wedge as well. Look how the volume just dries up, and then you get this tight little inside bar. See this tight little inside bar there, and then see how price trends. So it then moves from around about $51-ish, and then starts slicing through key moving averages at around $160, $130. These are danger signals. That is the end of the intermediate term trend. Also happened around the time of the earnings as well. But see the 52-week highs before and then soon after the breakout, but it's the tightness and price as well that happens. This one here, inverted head and shoulders, so typically seen in a downtrend or longer term consolidation. Volume on the left shoulder should be accompanied by an increase in volume. Volume on the head should be on a lighter volume. Volume on the rally after the head should show an increase in volume and preferably a greater than the volume seen at the left shoulder rally. Volume on the right shoulder should be the lowest of all, indicating a lack of supply selling. Volume on the breakout should be big, as you'd like to see on every breakout. Persolwski performance rank, much better this one, 7 out of 23, and bear market 6 out of 19. So let's take a look at a couple of them. So I've got some from 2022, 2023, SMH Semiconductor ETF. I'll show you the Qs in a second as well, and then I'll show you also a stock on the 1 minute chart. So left shoulder coming through here. So SMH, this is the semiconductor ETF. Left shoulder coming through here. Gap down reversal bar on the weekly chart, little shakeout demand tail at the low here, and then the right shoulder, see how the volume dries up. So ideally you would like to see the volume really drying up on the right shoulder. Why? Because it's an indication that price is, number one, putting in a higher low, which is structurally bullish, and as price pulls that back down, you'd like to see the volume drying up to indicate there is a lessening of supply, there is a lessening of selling pressure. So when I see SMH building a head and shoulders bottoming type pattern, or it could be say the Qs or the S&P 500 or something like that, or a group ETF or sector ETF, whatever it may be, I'm then really interested in individual stocks as well, especially if they start showing relative strength. So see how SMH here, and obviously Nvidia, huge leader, had a good trade in that. See how it's turning up here, the relative strength line. So in my head, I'm then going, okay, if SMH is building a inverted head and shoulders bottoming type pattern and the relative strength is turning up, there's going to be some very strong semiconductor stocks that are probably showing a lot of leadership. Let me then show you another one. This is Marathon, 1 minute chart, right? Left shoulder here, what do you notice about the candlesticks at the low? Shakeout demand tail. Here is the head. What do you notice about the volume? It dries up. Shakeout demand tail, bullish recovery, and then it builds the right shoulder here. And look how 1021 and the 50 SMA on the 1 minute chart, see how you get them converging, and then you get this tight inside bar, low relative volume, and then look at the trend there afterwards. And then look at the danger signals that then come through here as well. Now, just a little side note, this for me is applicable whether it is the 1 minute chart, the daily chart, the hourly chart, the monthly chart, the weekly chart, all charts. When a stock is trending, you're going to get bearish candlesticks. It is going to happen. So you see you get a bearish candlestick in here and in here, but what do you notice about the next bar? Immediately, buyers step in. Visually, you can see it. You can see this green bar here, shake out demand tail onto the 21 on the 1 minute chart, and then recovers. So when I see these bearish bars, and for me, I'm an intermediate term trend follower, so these bars are going to happen, and I'm going to see them, and I'm going to be in positions when they happen. Assuming it doesn't violate one of my sell rules. So this one here, it doesn't close below the 10 on the 1 minute chart. But you see here the very next bar reverses. So I like to look for on the very next bar either a bullish absorption bar or a bullish reversal bar. This is an absorption bar, this is a reversal bar. When you get back-to-back bearish bars coming through and they slice through, say the 10 and the 21 being the black and the blue line, that there, for me, is a very clear danger signal. So see here, bearish bar, bearish bar, bearish bar. There's actually 4 in a row here. There's 4 in a row. There's 2 very bearish bars here. Here as well, there's just no ability. So this is the danger signal. This is supply starting to become the dominant force. Triple Qs, left shoulder, head, right shoulder, there's the break in the neckline. So again, when I see the major indexes, sector ETFs, group ETFs, whatever it may be, building head and shoulders bottoming type patterns, which are more common, I would say, for the major indexes to do as opposed to individual stocks, like I want to be paying very close attention to what are the leading stocks, certainly after a prolonged bear market, like really be focusing on what are the leading stocks, dial it in. Now let's do a parabolic curve. So these are the proverbial going to the moon stocks. So more commonly seen towards the end of a major market uptrend, multiple bases, 3 to 5 as a guideline, usually occurred prior to the parabolic phase. So you can see base in here, base in here, base in here, base in here, and then kind of the parabolic curve. Parabolic best for as in a relative sense for the stock's character. So parabolic for a microcap biotech stock is going to be very different to Amazon or Netflix going parabolic. Makes sense? So let's take a look at a couple. So here we have right? And this is also the difference between arithmetic and log scaling. So this is the same stock at the same period in time, but you see how different the charts look. This is log scaling, this is arithmetic scaling. Same chart, same time frame, but just changing the scaling. You see that looks very, very different. So again, it's whatever works best for your pattern recognition. But remember what I said about going lower the bar, lower the bar, lower the bar, lower the bar, if and when I think it gets extended from the 10-day. All of the position, part of the position, it depends. But that is what parabolic looks like. Like that's what it looks like, okay? Now also, in terms of thinking about supply and demand, you see how early on when it's breaking out of these bases, you get really good large volume coming through. So this one here is a fantastic example. Stock builds, cup and handle type pattern, right? Here's the cup, here's the handle that forms in here, which is then kind of a little kind of like VCP or whatever you want to call it in and of its own right. And then it powers out, look at the volume coming through on the breakout. Really, really good to see. Then the stock rides here, but then look up here, right? Now you have very large relative volume coming through, and the stock, what's the context of the stock? The stock has just run from this base breakout here about $3.50 up to $70. So think about this large volume and think about the context of where are you seeing it in the stock's price cycle. I'm sure many of you are familiar with phase 1 accumulation, phase 2 uptrends, phase 3 distributional tops, phase 4 declines. So these parabolic curves, especially if accompanied by very large relative volume, like the biggest volume you've seen in the move so far, and if you can count the bases, 1, 2, 3, 4 bases, you're getting long in the tooth in terms of the base count. Like this is institutions offloading. This is not institutions accumulating positions up here. This is institutions selling to giddy retail traders, and potentially the stock is being hyped on social media, financial platforms and stuff like that. Tesla as well. Parabolic, right? So again, what's parabolic for Tesla will be different to parabolic for Riot, which is a crypto miner, which may be different from parabolic for Amazon, Apple, microcap biotech stock. So it's the context, the character of the stock is important when you're thinking about what is parabolic for that stock. Parabolic for Amazon may be a 50% move. Parabolic for a crypto miner may be a 1000% move. So it's context, context, context. So Tesla built a big base in here. You also had Elon Musk selling a shit ton of stock up here, specifically on this bar here. I think he sold about $3.5 billion worth of stock on this bar here. Big danger signal, clear change of character. But again, see how parabolic it goes, and look at the high relative volume coming through, and where, especially with Tesla, and you think institutions are all over this. So the high relative volume is indicative of an institutional footprint. Where are you seeing the high relative volume? Are you seeing it in the lows of the base? Are you seeing it on a base breakout? Or are you seeing it when the stock has just run from $240 to $400? Where are you seeing it? Where are you seeing it in the context of the stocks? Really important, I think. Let's do some here. So what are the type of stocks? So ideally, you're looking for continuation bases such as the ones that I was just blabbering on about now for around about 40 minutes or so, right? But it's also looking at some of the fundamentals. So you'll hear some people talk about TML, so like William O'Neill, a TML type stock, a true market leader. So let's just break down what are the characteristics of TML type stocks in a nutshell. Ideally, global product, so they have a huge addressable market, massive earnings, massive sales, strong and improving margins. There's a great story. There's liquidity there for institutions to get in and accumulate positions. There is outstanding relative strength, and the stock is at 52-week highs, or even better, at all-time highs, because if a stock's at all-time highs, there's very little overhead supply. Like, other than some day traders and some scalpers, anyone of any significance that's really owning the stock has a profit, so they're less likely to sell it. They're feeling good about it. Whereas if a stock has overhead supply, there's trap buyers there. When the stock starts to rally, those trap buyers, as they get near to break even, they start selling, which then puts downward pressure on the stock. But this is, in a nutshell, what you're really looking for. So now what I'm going to do is show you how to quickly screen for these kind of continuation-based breakouts. Okay, so we're on my screener. We now also have a free plan available with limited access. You can go and try that for free. You can create an account and you can use it for free. So let me show you. I've created a screen here, which I'm just going to call the continuation based screen. And I'm looking for stocks in the US and India markets. We have other ones. We have UK, we have Canada, we have Australian stocks as well. If I wanted to add some other parameters to this, such as momentum rankings, I could add more momentum rankings. If I wanted to add something around the earnings percentage change or the sales percentage change, I could add that as well if I wanted to. So these are the results that I've got back from the screen so far, and I've got US and I've got Indian stocks. I've got 170 stocks that have come back from this, and I'm going to look for stocks with the highest relative strength on a 12-month basis. So I'm going to come over here, and now I'm going to hit charts. I could hit flex charts and see the earnings and sales data. I'm just going to go charts, so then I can see them side by side, and I'll show you how quickly this is to do it. So the moving average you're going to see on these charts is the 21-day moving average, so that's going to come on. So this blue line here is the 21-day SMA on these charts, not the EMA. We only support the SMA on these charts. So what I'm basically doing is looking for stocks building consolidation patterns, flags, pennants, cup and handles, Darvis boxes, VCPs, whatever it may be, right? So you can see a nice base that was building in here. See how the 21 caught up, and then at it goes higher. So I'm scrolling down and I'm looking for stocks. WFRD, oil and gas stocks, showing a bit of strength at the minute, pulling back in. So what I may want to do is just flag this one and put it in a watch list. I just put this in a preset watch list, or I could create a new watch list as well. I'll just put it in a preset watch list for this moment in time. Then I could import it into TradingView, MarketSmith, TC2000, whatever I wanted to. Abercrombie & Finch, apparel stock, showing quite a bit of relative strength. Janelle Stainless, this one's showing quite a bit of relative strength here. See how it's starting to tighten, so I can just flag that one, put that into a preset watch list. I'll keep going down, see what else I can quickly find. So I'm just dialed in, looking for patterns, looking for strong stocks. Now I know these stocks are going to be strong because of the relative strength criteria that I've already put on the stock, looking for the strongest stocks on a 12-month relative strength basis first. Archrock, this one's looking quite strong. Another oil and gas stock. So again, if you have stocks from the same group cropping up and you've got it set on the highest relative strength over a 1 week, a 3-month, or a 12-month basis, it's probably telling you those stocks are quite strong. So Arrock's looking pretty strong. NE Noble Corporation, this one here, really nice. Gap down reversal bar, tightening, that looks pretty interesting. I want to be doing a little bit more research on that one. And then DB Corp, Indian stock, a couple of shakeout demand tails, 21 starting to catch up. That looks pretty interesting. Potential kind of maybe flag type pattern forming there. So I'll be tagging that one, so you can see how quick it is, how easy it is. Schlumberger, I'll finish with this one, potentially building a big cup and handle type pattern. So what I could do here, if I wanted to go and look at it on the weekly, see here, potential cup and a handle. I know my cursor's going over it, making it harder. Potential cup and handle. So 5 years the weekly chart. The 1 year is the daily chart. So see how the 21 is now catching up in here. That looks pretty interesting, so I want to tag that. I could go down to the 3-month as well. That would give me the 4-hour chart, and if I go to the 1 month, that would then give me the 1-hour chart as well. So I'll wrap it up, guys. Remember, there's a free plan now available of this. There'll be a somewhere to go do it on the website, basically, if you want to go and test it out for yourself. Thank you very much for watching and supporting the channel. I really do appreciate it, and I will see you in a future video.